Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. So I've been asked quite a number of questions over the last couple of months as to whether or not we've been repositioning our global equity portfolios and whether or not we've had a greater exposure to developed markets over emerging market equities. The short answer to that is yes, we have. We've certainly favoured developed markets over emerging markets, but that hasn't been something that we have positioned over the last 3 to 6 months since the global lockdown. It's been something that we've been repositioning over the last couple of years, and I just thought I'd share with you just some of our thoughts around that in this chart here. As you can see, this chart's just showing the relative performance between developed versus emerging market equities, and there's just a couple of points to note how we've been repositioning, and over the last 2 years that we've started to do that. As you can see there, just in the first annotation, emerging markets really started to have significant headwinds through the beginning of the US-China trade dispute, particularly through the early part of 2018, where developed markets continued to move higher. And then secondly, when the US Federal Reserve started to increase cash rates through 2018, even though that had a big negative for developed markets performance, financial market performance, it also created another second leg down for emerging market economies. This is on the back of emerging market currencies actually starting to depreciate as investors started to move out of emerging market currencies into developed market currency exposures, particularly the US dollar, on the back of higher cash rates. So throughout that period, we started to, as I said, reposition our portfolios. We thought that clearly the US-China trade dispute was going to drag on, and certainly, as I said, could be quite a significant negative for overall financial market performance in emerging markets. The second clearly has been COVID-19 and the associated global lockdown, which has caused a significant dislocation for the performance, not only of developed markets, but certainly also emerging market economies. But what we've seen over the last 8 to 10 weeks and the snapback in performance through equity markets more broadly, we've seen a stronger performance in developed rather than emerging market economies. And from our perspective, there's probably a couple of reasons for that. First and foremost, the ability for governments to respond to the healthcare crisis has been greater in developed rather than emerging market economies. Hospitals and facilities, infrastructure and the like has clearly been under significant pressure globally, but we've seen that more pronounced in emerging market economies. Their ability to be able to manage caseload and to be able to reopen at pace has been a lot slower than what we've seen in developed markets. The second has been the ability of central banks within emerging market economies to be able to respond, to be able to reduce cash rates in order to provide liquidity into financial markets, to be able to provide that support that financial markets needed, has also been more constrained relative to developed markets. In our view, that lack of liquidity has caused greater investor concern, and clearly we've seen that in the fact that the performance in emerging markets over this last little while has been nowhere near as strong as what we've seen in developed market economies. Now, will that change, and will that change our view as we head into the second half of this year into 2021? In the short term, we don't believe so. We think the outlook for emerging market economies over that medium to long term still remains very, very strong given the potential growth rates that we can see out of those countries. But until we start to see the global trade flow starting to open, they're very driven by exports. Until we start to see that start to normalise, industrial manufacturing and the like start to normalise, we think that emerging market economies are still going to struggle relative to broader developed markets, and that's ultimately going to be reflected in financial market performance. But nevertheless, through 2021 and beyond, we think that there is some significant opportunities in emerging markets, particularly when we look at the valuations between emerging markets relative to developed market equities. So we're certainly not out of emerging market equities. We think that they do provide not only an additional layer of diversification to portfolios, but as I said, that potential upside we think is absolutely there, but it's probably just not at this point in time over the next, as I said, 3 to 6 months into the early part of 2021. But as always, we continue to monitor that, and as we see those opportunities, we'll look to reposition portfolios accordingly. So hopefully this just gives you a bit of a snapshot on how we're thinking about our global equity exposure between developed and emerging markets. But as always, if you have any concerns or queries about your portfolio, please feel free to reach out to any one of our advisors. Thanks, and bye for now.